Hi everyone, my name is Syaiful Hidayat. I'm student of MBA School, class of September 2021. Here I will share you my journey of learning corporate finance with my lecture, Prof. Rai Sambal. In the corporate finance, I summarize in the sixth part. The first one is financial management and time value of money. The financial management is, as per Prof. Roy, the orchestration between internal and external financial resources to get value added. Financial management, there are four objectives: basic, operational, social, and research. What to manage? The capital structure, working capital management, asset structure, revenue management, cost management, cash flow management, growth management, risk management. What is the goal of film? Is maximize profit, maximize stakeholder wealth. Sometimes between manager and shareholder got conflict. Manager may not act in ways that maximize shareholder wealth. We call the agency problem. To avoid the agency problem, the company should apply the good corporate governance, that is transparency, accountability, responsibility, independency, and fairness. There are four cornerstones of corporate finance. Core value principle, value driven by return of investment capital and growth. Conservation of value, we can claim value by rearranging cash flow. Expectation treadmill principle. The more shareholder expect on share price, the better we must perform, keep up. Best owner principle. Business value depend on owner capability. We also learn about 5 business essential by Prof. Charan: cash, profit margin, velocity, growth, and customer focus. Time value of money application is financial planning, time deposit, control values, investment values, capital budgeting, and company values. The capital budgeting is the estimate expected future cash flows. Evaluate the project based on capital budgeting evaluation criteria. Decide whether which project is good or bad. 2 or more projects can be mutually exclusive, may choose only one. Independent may choose all good projects. In a capital budgeting, there are 4 parameters to evaluate. We are using a payback period, net present value, probability, and internal rate of return. The weakness of the payback period is subjective, not consider time value of money, not consider required rate of return, not consider all cash flow time project. The net present value is present value of cash inflow minus initial cash flow. The rule of NPV is Sept is if NPV greater than 0. Probability index is present value of cash inflow divided by initial cash flow. The PI rules is Sept if PI greater or equal than 1. Reject if PI less than 1. Internal rate of return. The rule is if IRR equal or greater than required rate of return, then accept. If IRR less than required rate of return, then reject it. Investment. In investment, there are 2, active investing or passive investing. In active investment and active investing, we have to know the fundamental analysis and technical analysis. Fundamental analysis, is about the domestic global economy analysis, industry analysis, and company analysis. In a technical analysis, is we are looking for the chart or the graph of the share. That is the momentum and reversal, trend up and down, support, resistance, gap, triangle, asymmetric or asymmetric, bottom, double top. For the passive investing, we just follow the market. In the market value, there are intrinsic value versus market price. The intrinsic value is calculated by investor. Basically, it is discounted future cash flow. And for the market price, consensus value by market participants. To take the decision is if intrinsic value greater than market value, buy. If the intrinsic value less than market value, market price, then sell or short sell. If the intrinsic value equal to market price, then hold fairly price. In an investment, we have to know the financial statement of the company. Then we have to analyze the report. First is the risk of return. The component of risk of return is probability, profitability, investment return or asset, return on equity, liquidity, activity, leverage, market ratio, dividend yield, or PER, price earning ratio. We should also analyze healthy or not healthy of the company. We using the natural level example CR of greater than 1. Quality of number CR, QR, historical trend, getting better or worse, industrial benchmark above or below average, the composition using a DuPont value. What is DuPont value? The DuPont value system summarizes key relationship which determine the overall performance of the firm. Return equity, the formula of the DuPont is return equity equal to return on asset divided by 1 minus total debt per total asset. CRPM, the portfolio theory, important point, potential future return, actual historical return, required return, ex ante probability, probability weighted versus ex post simple, historical average, measurement, return versus risk, total risk, systematic risk, and unsystematic risk, correlation and diversification, efficient frontliner, portfolio theory, and CRPM, capital asset pricing model. What is the CRPM? The model that describes the relationship between the external return and risk of investing in security. It shows that the expected return on a security is equal to the risk-free return plus risk premium, which is based on a beta of that security. This is the graph of the capital asset pricing model. In this graph, we show that the more risk the company, is more higher beta. Normally, the beta of the market is 1. Capital structure. The capital structure, we are learning about Modigliani and Miller theory. That is, there are two proportions. Proposition 1 is, this proposition says that the capital structure is irrelevant to the value of firm. The value of two identical firms would remain same and value would not be affected by choice of finance adopted by finance asset. The value of firm is depend on the expected future earning. It is when there are no tax. The proportion 2, this proportion said that the financial leverage boosts the value of film and reduce WACC. In this, when the type information is available. And this is the optimal capital structure. The optimal capital structure depend on the business risk and financial risk. For the high leverage, the capital structure may be debt higher than the bigger than equity. A firm attempt to balance the cost and benefit of debt to reach the optimal mix that maximize the value of the firm. Effect on cost of capital. Since the debt is cheaper than equity, used debt will initially lower the WACC. At high level of debt, the WACC will increase as investors perceive the firm to be riskier. Capital restructuring. We are learning about the process of integral financial distress. The company starting to early impairment and then finally bankruptcy. To outcome the financial distress is as follow: the turnaround opportunity. That's mean operational restructuring, asset restructuring, financial restructuring, and the other is the problem permanent, and then private liquidation or file for legal bankruptcy. They also the LBO or leveraged buyout RGR Nabisco study case. And that study case, what is the LBO? The mechanism, who is buying that, what form, and whom using whose money, and what are the source of value creation in LBO? Explain potential conflict of interest in LBO. Is LBO good or bad for the economy? The last part is fraud risk management. There are three angles of a fraud or corruption: because of opportunity, weak internal control, ineffective monitoring, because of pressure, financial pressure, work pressure, because of rationalization. I will pay it back. I think I deserve, I got it. It is good for a good purpose. To avoid fraud or corruption, the company should apply whistleblowing act of reporting misconduct to managers, executive, or other authority with the power to take correction. That's all we are learning in corporate finance. Thank you, Prof. Roy, to teach us, for teaching us good, fun, enjoyable, and easy to understand. Ready to make mistake for right thing. Good morning.